This is a little bit of my credentials. My name is Lawrence, obviously, and I'm a property investor and author. This is my latest book, Financially Free or Financial Freedom Through Property. Digital entrepreneur, the founder of My Property app, and student accommodation and multi-let is where I specialize. I want to also just say a very big shout out and thank you to all of you guys who are on the call today, and not only on the call today, but the ones that have joined all the other webinars and have shared all of our content. And it's with your help that I'm very proud to announce that we've sold 1,200 copies of my book. And that was, I think it was 3 months ago that it went live. And it went live through COVID, through lockdown, and it has still been such a smashing success. So thank you if you bought one, or if you shared a post, or if you just liked something and it ended up being a sale for my book. I really am appreciative of that. For those of you who don't know, the reason why I got into property is to become a writer and to become a full-time author. But, you don't make a lot of money as a writer, so it's more a passion project. But I thought that if I could get the property stuff together and that my property income could look after me, I could then focus my time and attention on my passion projects. So yeah, just a very big thank you. Thank you for coming out tonight. Thank you for being a part of this. I love doing this. I love having you guys here. I love learning and growing with you. Just a quick reminder, on the 18th of this month, the 18th of July, that's next week, Saturday, we're going to be holding and hosting an exclusive half-day workshop. Now, in this half-day workshop, I'm going to take you through a whole lot of things. Basically, the main principles and steps to becoming a property investor and to achieve financial freedom in less than 5 years. So you can just click that link, this little green link that's on your bar. It'll be on the whole night. If you want to get registered for this event, it will be 400 Rand to attend, and it's from 9 a.m. to 1 p.m. At the bottom there are the learning outcomes. Let's jump into the first, essentially piece of content. And what we're here to discuss today is investor-friendly finance to build a portfolio. Now, my focus tonight, ladies and gentlemen, is going to be on bank finance. I've got lots of videos and content on my YouTube channel around private finance, around rent-to-rent, around stokvels, all of those other different creative financing techniques. For tonight's conversation, we're only going to be speaking about bank finance. If you do have a question about another type of finance, we can obviously discuss it, but I just want to keep tonight quite focused. So the agenda, first of all, I'm going to just spend 5 to 10 minutes taking you through the basics of bank finance. So what are some of the insider terms and jargon, and what are some of the elements you need to understand to decide on what type of finance? Then the meaty part is I'm going to share with you how the insider property investors, the guys who have most of the property wealth, how they use the bank to leverage an infinite amount of money, which is very interesting. Some pros and some cons to bank finance. Obviously, every type of finance has good parts and has bad parts. And you just need to understand both sides so that you can make an effective decision. And then finally, I'm going to share with you how to build the perfect investor proposal. And an investor proposal is really there to help you raise money from a private financier. But also, I found it very handy when looking for bank financing as well. Okay, so the basics of bank finance. What I am going to do, sorry, ladies and gentlemen, is I'm going to speak quite quickly. I'm going to go through all of this content. We always provide a recording afterwards, so you're welcome to go back and listen to something if you thought it was interesting and you maybe didn't grasp it the first time. I'm going to go quickly through all the content, and then right at the end of the webinar at about 10 to 7, I'll spend 10 minutes answering a couple questions, and then we'll go on our way. So please excuse me if I do go quickly. It's just there will be a recording afterwards, and I want to make sure to get through all of it. So the basics of bank finance. Let's say that you're about to get into the property game. You found a nice, 2-bedroom apartment somewhere, and the financials seem good. The numbers make sense. So you want to now approach the bank to be able to get a loan on this property. What do you need to know? Well, first of all, bank financing is what we refer to as the institutional arm of the property market. So it's really your big banks, right? It's your Nedbank, your Absa, FNB, Capitec, Nedbank, maybe SA Home Loans would also fall under that category. And a bank is essentially going to be the cheapest financing you will ever get. Now, I know that sounds confusing, especially because a lot of people was mentioning on the chat bar that they thought that bank financing was actually the most expensive or an expensive route to financing a property. The truth is it's actually one of the cheapest. Now, the key thing that we need to understand when we're looking at bank financing is that they look for collateral to lend against. Collateral to lend against. So what they're going to do is they're essentially going to evaluate the asset. And if the asset, being the property or being the collateral, has enough value, they will then loan you a portion of that value back. The way the banks work, right, is let's say they'll loan you R1 million to buy the property. But if you default on that property bond, i.e. you don't pay the monthly installment, what the bank's going to do is they're going to repossess the property. They're going to take it back into their own possession. They're going to sell it off and they're going to recover their R1 million that they loaned you. Now, that's why banks don't usually loan at 100% value. So if the property is worth R1 million, they're probably not going to give you R1 million loan. They're going to give you maybe a 90% loan. So they're going to give you 90% of the value of the property, which means they'll loan you 900,000. You have to come with a deposit of 100,000. Now, the reason why they do that is because they're trying to protect themselves. If you default on your property, right, it's worth R1 million, you've got a 900,000 rand loan. The bank will repossess that property. And what they'll do is they'll just try and sell it for 900,000 to recover their debt. They know that they can sell for a 10% discount. They can sell at 900,000 quite quickly. So that's why banks are sometimes hesitant to come with 100 or 110% loan to value. Now that brings me to the second point, loan to value. What does that mean? The percentage of how much of the asset's value that the person or the bank is willing to loan. 90% means 900,000 out of R1 million. That's what they will give you as a loan. Interest rate. Now, this is where we determine if financing is expensive or cheap. Now, when you're looking at the bank, they're going to give you the most competitive interest rates because they're working directly with the South African Reserve Bank. So they get an interest rate from the South African Reserve Bank, which is known as the repo rate. They then put their markup on that and they rent it out to us, or they lend it out to us. Now, if you're going to go and try and raise money from an investor, a private investor, for example, most likely they're going to charge you 12 to 15% interest per year, where the bank will charge you what we call prime, which is essentially the minimum interest rate that the banks are allowed to lend to almost. They'll give you prime, which currently sits at 7% plus 1. So they'll loan you the money at 8%, where an investor is loaning to you at 12, 15%. Huge discrepancy there. If you look at commercial banks, they're also 10% plus. So when you mention on the chat bar that banks are scary because they're expensive source of financing, that's actually not true. They're actually, in my opinion, probably the cheapest. And then finally, the last thing you need to realize or understand about the banks is that they don't lend on the value of the asset necessarily. They lend on the OTP. Okay, now the OTP is an offer to purchase. That is when a seller and a buyer come together, they sign a document and get into an agreement about how much they're going to buy the property for. So let's say we take that same example. You've got a R1 million house. Now, in your offer to purchase, you've decided to go in with a really low offer. Let's say you've gone in with 700,000. So it's worth R1 million. And its book value is R1 million, but you've gone in with an offer of 700,000 and the owners accepted it. Now, the bank's not going to give you a loan based on this figure here, the R1 million, the value of the property. They're going to give you a loan on the lower price, the offer to purchase price. So they're going to say you've offered 700,000, so we'll give you 90% of 700,000, not of R1 million. Now, one of the questions that came out, Nikhil asked, is what is the benefit of refinancing a property as opposed to just getting a new home loan? When you're getting a home loan, when you're getting a loan off an OTP, OTP is the value that people will loan against. If you're refinancing your property, you can refinance at the R1 million and you can extract some money out. So it's a complex explanation, but in the question section, I'll unpack that a little bit more. That is basically the key thing you need to understand is that banks lend on collateral. As long as the property makes enough financial sense and it's valuable enough, you should, in theory, be able to get a bond. So let's look at an example, right? Let's say that we've got a loan to value of 80 to 90%, the loan terms of 20 or 30 years, and we've got an interest rate of prime plus 1. Now we're going to go to the bank and we're going to ask for R1 million loan. Okay. So we'll look at two options. Let's say you're going to go for an 80% loan to value or a 90% loan to value. All right. So the bank is going to, if you go for the 80%, the bank is going to give you 800,000 Rand to purchase the property. You have to come up with the remaining 200,000. That is your deposit. The 90% is obviously they'll loan you 900,000, and thus you need 100,000. Let's assume that the interest rate is 10% for both. This will become your monthly repayment. Now, this is incredibly important to know because when you're running a deal, you need to run the deal with these numbers included. If you're running your cash flow numbers, for instance, which is your rent minus your expenses, this is going to be one of your primary expenses. Now, if you were to, make that interest rate 15%, you must check how high your monthly repayment will go. So interest rate, that is determining how expensive the financing is. Interest rate. So please make a note of that. The interest rate determines whether financing is expensive or cheap. Okay. Let's look at a quick example here, a live example of a flat here in Berea. It's a 2-bedroom, 2-bathroom, 127 square meters. I've assumed a 90% loan to value at a 10% interest rate over 20 years. So what you would do is you take that figure there, which is the asking price, right? You times it by your loan to value, so the 90%. That will be what the bank is going to give you in terms of financing. So 355, 500, you have to come up with the rest. Now your interest rate, to determine how much interest you're going to pay, you take that 90% value, that 355, you times it by 0.1, which is 10%, and you divide it by 12 so that you can work out what your monthly interest rate will be every single month. So you can see for this type of deal, you're going to be spending about 3,000 Rand on your interest, and then there might be a small capital portion, which will make up your bond repayment. So it's a quick calculation. You can quickly see, okay, if I were to buy this property at 395, I would pay about 2.9 to my interest. You can then take your levies, your rates and taxes, all of those different things. You can work out your cash flow. You can then determine your ROI and then make an investment decision to say, yes, this return warrants this risk. Now, the key criteria, this was another question that came up, is, do I have to be employed to get bank financing? Do I have to have a certain this or a certain that? And the answer is yes. Unfortunately, the first thing that the bank is going to look at before considering you as a client is credit score. Now, I like to use a tool called clearscore.com. That's www.clearscore.com. It's a free tool and it gives you your credit score pretty quickly. So here's a quick snapshot of my score. The higher your score, the lower your risk to the bank. The higher your score, the lower the risk to the bank. Now, when the bank looks at an individual and they see a very high credit score, what that's telling the bank is that this person knows how to work with debt. They maybe have a credit card that they've paid off, or they've got bond repayments and they've never missed a payment. So there's different things that are obviously seen as good items on a person's credit score. So the higher your credit score shows the bank that you know how to manage debt, which makes you a lower risk customer, which means they give you more competitive interest rates. So they'll be willing to give you a higher loan to value percentage, plus they'll give you a lower interest rate. So for instance, on one of my buy-to-lets in Fourways, I'm getting prime minus 1.5. So that current rate is, I think it's about 6 or 5.75 interest is what I'm currently paying. Obviously, that's a big thanks to the SARB that has substantially reduce the interest rate. The other two things that the bank is going to consider is affordability and the deal. Now, the affordability is the key one. Now, this I got from ABSA. These are the types of income that ABSA will consider for your affordability. Okay, so number one, full-time income, a salary earner. If you've got a salary, guys, the bank is going to be the easiest, cheapest, and best way for you to get started. Self-employed individuals, if you've got your own business and you're earning a steady income stream, weekly wages, commission and overtime earners, interest income, housing subsidy, maintenance payments. And then the final two are quite interesting. Rental income. So what APSA is saying, I'm not sure if the other banks are in agreement. Everybody's got their own approach, I think. But what APSA is saying is that if you've got a property that's making, let's say, 10,000 Rand rental per month, they're going to take 80% of that and add it to your affordability. So your salary is, let's say, 30,000. Plus, you've got this 10,000 Rand worth of rental income coming in. What the bank's going to do is they're going to take that 10,000, take 80% of that, so 8,000, and add it to your salary of 30,000. So now your affordability is not 30,000 anymore, it's 38,000, which, as I'll show you in the next section, that is how you lend infinitely from the bank. So take a print screen or take a picture or write down. These are the different things that the banks will consider as affordability. And then finally, the third thing that the bank is going to consider, obviously, is the validity of the deal. So is the deal in a good area? Is it at the right price? Does it make financial sense? That's what they're going to look at. So if you can have a good credit score, an affordability that the bank likes, and a deal that makes financial sense, you should have no problem raising the money from the bank. Now, there's a quick calculation that I'd like you to just make a note of. Whatever your disposable income is, times by 100 will give you a sense of what your loan facility could be. What your loan facility could be. So, for example, let's say you earn 20,000 Rand per month. And of that 20,000 Rand, 15 goes to living, basically. So it goes to your home loan, it goes to your car loan, it goes to your groceries, everything. So you live on 15,000, but you make 20,000, which means you've got 5,000 Rand in disposable income. If you take 5,000 and you times that by 100, it equals 500,000. That is more or less the amount of loan that you could get from the bank. So whatever your disposable income is today, times that by 100, and that's the kind of loan you could likely get from the bank based on your affordability. So that, ladies and gentlemen, is just the basics of bank financing, right? Bank financing are the big five that you're seeing on the screen now. Those are the guys. It's the cheapest lending you're going to get. They are quite strict. There has to be a good credit score. Your affordability has to be on top of things, and you need to have a good deal that makes financial sense. So as long as you've got those three things, it's very easy to get this kind of lending from the banks. Okay, now we get to the meat of it, which is all about the infinite lending from banks. The infinite lending. Now, please, ladies and gentlemen, give me just another 10, 15 minutes of undivided attention. If you can grasp this, there's nothing stopping you from taking over. Okay, so why do so many property investors not grow past 2 properties? Now, here are some stats. 73% of property owners own 1 to 2 properties. 16% own 3 to 10. And only 12% of people who own property in South Africa own more than 10. Now, what you're seeing here is you're seeing some sort of massive decline, right? 73% to 16%. That's a crazy jump. How are people getting so stuck on the second property? The answer is affordability. The answer is in affordability. Okay. Let me show you an example. Most people have not been educated to see a property as an investment or as an asset, right? Now, the difference between an asset and a liability is very important. An asset is something that puts money into your pocket. Okay. An asset is a house that has more rental income than expenses. An asset could be a car that you're renting out as an Uber car, and that income you get from your Uber is more than your expenses. Then it's an asset because at the end of the month, more money is going into your pocket than leaving your pocket. A liability, on the other hand, is exactly the opposite. There's more expenses than there is income. So, for example, a car that you buy but you don't use for Uber is not an asset. It's a liability. It's something that depreciates in value, and it costs you money every month. You pay petrol, insurance, maintenance. It just takes money out of your pocket until you put it on the road and as an Uber driver and there's income coming in. A car is not an asset. For instance, this house that I'm going to show you now is what most people would consider an asset, but it's actually a liability. Okay, so let's have a look here. This is a 2-bedroom apartment for sale in Edenvale, which is in the east of Johannesburg, in a very popular area called Greenstone. Okay, so the monthly rental on this property is 9,000 Rand. Now, most people would look at this and they'd say, okay, cool, 9,000 for almost R1,000,000. That seems like a decent investment. And, most people would just buy this house for R1,000,000. Okay. Now, that would mean your monthly bond would be 7,077 Rand. And that's in the very positive interest rate climate that we have now, right? At the 7% interest rate that we have now. Then you've got levies that come on as an expense. You've also got rates and taxes. You've got a management fee, so someone to manage the property, and you've got maintenance fees. You've got to put some money aside for when you have to repaint or, voids when there's not going to be a tenant in the property. So at the end of the day, this person is earning 9,000 Rand rental, but because their expenses, bond, levy, rates and taxes, management and maintenance fees are so high, they're losing 1,627 Rand. Is there anybody else on this call that has ever lost money like that? I know my first deal was like that. My first deal was a 2-bedroom in 4 ways. I bought it for asking price, and I lost my first 5 years. I was losing 3,000 to 5,000 Rand per month, and I thought it was normal because no one at that time had taught me the difference between an asset and a liability. I used to think that just owning a property is an asset. It's not an asset. This is making you poorer. You're losing 1,627 Rand per month. You're becoming 1,627 Rand per month poorer every single month. So the massive shift or the mindset change that I'm hoping to trigger you today is if you're finding cash flow positive properties, you're going to become the bank's best friend. Okay, now let's look at this. Losing 1,600 doesn't sound so bad, but now what does this do to your affordability? It destroys your affordability. Because let's assume you've got a salary of 30,000 Rand, right? A third of that I'm going to call disposable income. So remember, the disposable income times 100 gives you your bondable amount, or the amount that you could loan from the bank. So this specific individual is earning 30,000, maybe spends 20,000 on living expenses, has 10,000 Rand left over. So because of that, the bank is willing to loan them R1,000,000 Rand. But now they buy property number 1, which is losing 1,627 Rand. So this person needs to jump into their salary of 30,000 Rand and cover the shortfall of 1,600. They have to cover that shortfall, right? Then they buy a second property, losing 3,523 Rand. It's in a better area. It's in a much better area, but it's still not making any cash flow. It might appreciate in value. In 10 years' time, it's going to be the best area and I'm going to make so much money. But what about now? Then this person buys property number 3 in an even better area. They go to Sandton this time because owning property in Sandton must be a good idea, right? Well, now they're losing 4,800 on that property. After those 3 properties, now their salary is 20,000 Rand because they have to spend 10,000 Rand on the shortfall. Now they've got no more affordability with the bank because the bank looked at them and said, you've got 10,000 Rand left over to be able to afford a house. But you're now spending that 10,000 Rand on 3 bad property deals. That is why, ladies and gentlemen, 73% of people only own 1 or 2 properties. Because what they do is they buy bad investment opportunities. They buy liabilities, which erodes their affordability. And the banks look at them and say, you're too high a risk. Does that make sense? Now let's imagine that we had to do something differently. Let's say we went for the right deal instead. So I'm going to take that same Berea flat that I had in the beginning, right? Now, what you can see here on the right-hand side is that the second line from the bottom, rental income is a gross amount of 7,400. Okay. So step number 1 is we buy at a discount. So they're asking 395. We're not going to offer 395. The game of property is won by buying low. So we're going to buy it at 320. Now, this is how the numbers would look. Monthly rental of 7,400. Monthly bond of 2,276 based on an offer price of 320. Levies, rates and taxes, management fee, maintenance fee, and boom. Now there's a profit coming in of 2,294. Now, that doesn't sound like a lot of profit, and that probably doesn't feel like financial freedom. But that is now making you 2,300 Rand richer per month, which is also giving you more access to the bank. Now, let me explain. Okay. This is building your affordability. If we've got the same individual, they've got 30,000 Rand worth of salary, which means they've got R1 million they can bond. But then they buy property number one, which makes them an extra 2,300 Rand. Then they buy property two, making an extra 3,680 Rand. And then they buy property number three, making them just over 4,000 Rand profit. You add those three together, and now this person has a salary of 40,000 Rand, not 30. The bank takes a third of that and says, right, we can bond you for more. So although this individual has three properties, just like the other individual, because he's bought or she's bought the right properties, built her cash flow, built her affordability, she has now more capital to be able to pull from the bank than the other individual. If you're buying positive cash flowing properties in the right areas and you've got a decent affordability, and I mean like a steady salary, guys, there is no limit to how many properties you can buy. That's the beauty, and that I hope this is ringing true, and I hope that this is exciting you, because with the use of the banks and with the use of understanding positive cash flow, if you combine those two together, you've got an endless stream of income or stream of financing that you can access at any time. And I've already mentioned, it's the cheapest financing you're going to get. So, to keep it short and sweet, basically what I'm saying is when you have the right deals with positive cash flow, you can access infinite lending from the banks. And I'm not saying this as something that I've heard. This is something that I've practiced. So I've bought about 8 properties with bank financing. And it's not because I earn a massive salary, but it's because there's enough income in the properties that I have that it keeps bolstering and it keeps adding to my affordability. So I keep going back to the bank, and the bank says, cool, Lawrence, your affordability is good. Plus you've got all these extra property income. So we'll add that income to your affordability. So you've got plenty of access to our financing. It's not something that I'm just talking about. This is something that works. Okay. So let's get a little bit more practical. I've got a very good relationship with one of the home loan directors in ABSA. He's also big into property investing. He's read my book, and he's a fan of the stuff that I do. So we get into conversations often, and he shared some information with me. So the slides that you're about to see now are actually ABSA's slides. I'm just using them to show the principle and show you what ABSA is willing, or how ABSA is willing to help South African investors. Okay, so here's an example of, here's a quick scenario of a lady by the name of Patience. Now, she has a good job. She earns 30,000 Rand per month, and she's incurring 14,500 in personal expenses. So her disposable income is 15,500. Remember that calculation I told you? Take your disposable income times it by 100 will give you a rough estimate of how much your affordability would be with the bank. Okay. 100,000 Rand home loan. Okay, that's not really important, because here what you can see is essentially her cash flow statement. So you can see the income that she's got there of her salary. She's also got some of her monthly expenses. And at the end of the month, she's got 15,500 in disposable income. And then right at the bottom, what you can see there is her available financing is 1.553. So that's where this calculation that I explained, where you times it by 100, will give you a sense of what your available financing is. Okay. Now, let's say that Patience decides to become a homeowner, and she buys a home for herself. Now, just quickly, who here thinks that a home that you buy for yourself is an asset? Just quickly put it in the chat bar. Do you think it is an asset, or do you think it's a liability? Let me see who thinks it's an asset, who thinks it's a liability. Come, guys. Who's gonna be the first one? Okay, so Tulani's saying no. So Tulani, is it an asset or is it a liability? Okay, Molefe, a liability. Okay, why is it a liability? Everybody thinks it's a liability. Why is it a liability? Is it a liability because you're losing money every month? Is it a liability because your wife or your husband has to stay there and you don't like living with them? Cabello, a home for yourself is a liability unless you rent it out. Liability, okay, unless you're renting it out. No money coming in. Bokang, definitely. Okay, Lawrence says it's an asset. Lawrence, why is it an asset? Okay, and then Fulufelo says it is a liability. Yeah. Sam, losing money every month. Okay, Mokate says, I will say asset because of equity. Now, Mokate, that's one of the best points. And I'm so glad that you mentioned that. What you're doing is you're not investing anymore, you're speculating. When you look at a deal and you say, I'm investing in it because the equity is in the property, unless you're buying equity, if you're buying it saying that in 5 years' time it's going to be worth more, so I'm buying into a plan that means it will raise an equity, what you're doing is you're speculating. Does that make sense? Okay, cool. Cool. I just wanted to take a quick break, make sure you guys are still with me. Okay, so patient takes up a 950,000 Rand loan to buy a home for herself. When we hear that, we think she wants to buy a liability for herself. The loan costs her 8,550 per month, which decreases her disposable income, right? She's got more expenses, less disposable income. So the bank looks at her and says, yeah, you don't have enough money to loan to you. Okay, so this is what it would look like now. She'd have a home loan of 950. Her income wouldn't change because she's not renting out any part of this house. Her expenses will increase. Her disposable income will go down. And look at the financing she has left now. She only has 700,000 Rand worth of financing left. Guys, this is the biggest thing that I can teach you is if you're not buying an asset that has a positive cash flow, eventually you're going to run out of affordability. That's just how the banks work, right? Affordability is unfortunately one of the things that is a must. You don't necessarily need a salary yourself. You can use somebody else's salary and partner with them and use their credibility. But at the end of the day, if you're buying bad assets, if you're buying liabilities, eventually your business is going to go under. Okay, so Patience has now learned that, or she's bought her own home, and her home is going to be an asset for her because she gets to live there and she feels comfortable. Now she decides to buy her first investment property. Okay, so she's buying it for 650 and renting it out for 7,500. So here we go. We've got now income coming in, not just expenses going out. Okay, so here we go. Now, rental number one. She increases her home loan. She's got now 1.6 in debt, but she also increases her income. Now, the reason why this line here is in yellow, the 6,000 Rand, is remember, the bank is going to take 80% of the rental income as added to your affordability. They're not going to take the full 7,500. Right? Her expenses increase because she's got, a bigger loan facility. And now her disposable income is 5,400. Again, she's reducing her available financing. She's buying the right kind of investment because there's a big enough income to cover the expenses, but she's still running out of affordability. So I hope that this quick explanation has shown you why somebody like a Patience has gone through this whole process and has now ended up being more limited to get financing from the bank. Whereas if she went for great positive cash flowing deals from day one, she would have been able to build quite a substantial portfolio with the 1.5 million. Right. So one of the questions that was also on the chat today was what bank is the most investor friendly? From my experience, it would be Absa. I'm not employed by Absa and I'm getting no kind of commission or referral bonus by telling you this. I've spent quite a lot of time with Absa. They're very interested in the investor market. These are the two products that I would recommend you go and research a bit more. The first time investor. So this is where they are willing to give you up to 105% home loan. So they're willing to pay 100% of the property plus give you 5% for your buying costs, like your transfer fees and your bond registration costs. So they're essentially giving you a property without any capital down. Okay, you have to have an NQF 8 qualification or above. And then the buy to let model is, where they will give you 100% loan to value for a buy to let, and they will look at your existing income and add it to your affordability. So if you're on the first time buyer market, look at their first time investor product. Otherwise, go check their buy to let. Definitely, in my opinion, one of the most innovative banks when it comes to investors. So infinite lending, the key message here, infinite lending comes from positive cash flow. Positive cash flow. Okay, before we go into the pros and cons, I want to quickly just bring up our call here again. Now, please can you share with me one word that describes what you have learned, or one thing that stood out for you? Just type it in the chat bar, one thing that's come to you, or one thing that you've really enjoyed about the infinite side of bank lending. Let's have a look here. Who's going to be the first person to type something about what they've learned? Come, let me see. I just want to take a quick break from the slides, make sure that the audience is still here. Fulufelo, okay, finances. Kabelo, affordability. Yeah, Kabelo, it's really important. Affordability is critical. Lawrence, possibility. Awesome. Molefe, infinite return, cash flow, scalability. Yes, Tulani, scalable. I think that's what you need to look at. The banks are massive. Banks are the richest organizations in South Africa. Let's just leverage them. Sam, it's actually attainable. OPM unlimited, positive cash flow. Berea, not green. Okay, awesome. You guys are all with me. I don't know what's happening tonight, but I'm having a great time. I hope you guys are also having a great time. Okay, let's go to the pros and cons of bank finance. So, number one, the good, the bad, and the ugly. The positive sides. Number one, infinite lending. Okay. Even if you're working with a very, very wealthy individual and you're loaning money from them, eventually the money will run out. The banks, they're not going to run out. So there's an infinite portion of lending that you can get from the banks. And number two, it's got the most competitive interest rates. If there is someone on the call that has better interest rates than, let's call it prime, let's call it 7.5%. If you've got some sort of investor or you've had an experience where someone loaned you money for less than 7.5, please let me know. Please put it in the chat bar. As far as I know, that's not possible. So in my opinion, the banks have the best interest rates. The negatives. Okay. Banks are risk averse. Right. So unless you've got a good credit score, unless you've got a strong deal and it makes a lot of financial sense, and unless you've got some sort of steady income or paycheck and your affordability is good, the banks are likely not to loan to you. Now, one of the questions that I did have from the audience today was, what if you don't have a salary? Now, that does make it tricky, but it doesn't make it impossible. Okay. For those of you who don't have an income, a steady income, what I would recommend you do is two things. Look at the rent to rent strategy and look at the sourcing strategy. I've got a whole lot of videos and content on my YouTube channel and also on the My Property app blog. Go check it out. Rent to rent and sourcing. Those are two strategies that require very little money to get started. But what they will do is they'll start to improve your affordability. So the rent to rent is where you rent a property from an owner and then you sublet to a whole bunch of other people. But what you sublet it for is more than what you're currently renting it for. So let's say you're renting for 10,000, but you sublet to a few students and you're making 20,000. What you've done there is you've created yourself a recurring income of 10,000 Rand per month. If you can then slowly start to build on that, if you've got 6 months worth of financials for that rent to rent, you can go to the bank with that 10,000 Rand and say, this is my affordability, loan R1 million and Bob's your uncle. So that's a way to get started. Or the sourcing is where you find an investment opportunity for someone, you do the negotiation, you put together a nice investor proposal and you sell it to the investor for a fee, 20, 30,000 Rand. Right. Again, what you do is you do at least one of those deals per month. You slowly start to build up a track record. Again, you've got 6 months worth of deals and you've done 30,000 Rand worth of sales every month. You can then pay yourself a salary. You go to the bank and say, listen, look, I've got a regular income. So those are ways you can get started into property. But what I can tell you is if you want to scale and build a property empire, you need the banks. The banks on the negative side are also oftentimes inflexible. I've struggled to get loans for multi-lets. When you're doing like a standard buy-to-let, a little Berea investment, the banks will happily loan you the money. If you're looking at a house in Four Ways or in Belito or wherever it is that you stay, you'll probably get a bank financing. But if you're looking at like a multi-let, a block of flats, student accommodation, sometimes the banks are a bit finicky. Okay, we've got 15 minutes left, and I've still got this final section to take you through, which is designing the perfect investor proposal. Okay. Now, an investor proposal is a document similar to a business plan, I could say, where you're trying to get lending or you're trying to get money for a property investment. Now, an investor proposal is something you can take to a private investor. It's something you can take to an investor to sell off a property, to source a property, or it's something that I often use to approach the bank and show the bank that they're not just giving me a home loan. They're giving me almost a business loan at competitive interest rates. I want to show them that I'm a business person and that I'm going to de-risk their investment. Because the bank, that's all they're thinking, right? The bank is constantly thinking, how can I save? How can I reduce my risk? If you can show them the numbers, show how great this opportunity is, the bank's going to feel more comfortable to loan you money. So an investor proposal needs a couple of things. One, it needs to have your cash flow numbers. It needs to show, why is this a good deal? Why is this a good investment? So that's a key thing to add. A personal introduction. I like this. I don't know if it's needed in an investor proposal, but if somebody's going to be loaning you the money and you're the entrepreneur, or what sometimes people refer to as the jockey, the people want to know who it is that's running this business in the back end. Another important thing that I like to do, and what I've seen the banks respond really positively to, is a bit of stress testing. Right now, stress testing is a very simple concept. Right, stress testing means that you test your deal from different avenues. So let's say that now we've got great interest rates, but let's say in 2 months' time the economy recovers, and all of a sudden the SARB throws up the interest rates another 2-3%. Right. So now instead of getting 7% loans, interest rate loans, we're now getting 10% interest rate loans. How's that going to affect your numbers? What if you buy a property and it's empty for 3 months when you were only expecting it to be empty for a month? How's that going to affect your numbers? So that's where I put my, call it my stress test or my scenario-based assessment. I also put that into my proposal. And then finally, some sort of executive summary or a high-level summary of what the deal is. Okay, so let's look at that a little bit more detail. The personal introduction is very important. This is where I think it's important to build credibility. Now, that photo that I've used there is probably not the best photo. That's my sister's wedding that I put there. It's probably not professional enough. You want to have a really professional photo because you want to be targeting, investors or the banks. You want them to take you seriously. And then what you want to do in your introduction is you want to build yourself up. You want to talk about your experience, your credibility, lessons learned, something that when the bank reads it, they're going to be like, okay, this guy knows what he's talking about. For me here, I've said I've coached over 50 people into property. So not only have I done property myself, but I've enabled and empowered other people to get into property. And that's almost my credibility that I will use. When we're looking at the numbers of your investor proposal, you need to show either your cash flow numbers, so income, expenses, profit or loss. Okay, that is very, very clean, very simple. The bank can see that you're making roughly 359,000 Rand per month. Those are your expenses. Your cash flow is 170,000 Rand. The bank's going to be like, well, this deal makes a lot of financial sense on the surface, so we should consider it. Okay. On the bottom right, you're seeing some high-level property values. So that's some of the key information that the banks also want to see. So asking price, offer price, discount, return on investment, gross yield, net yield. That's almost the executive summary. That gives them the high-level flavor of what's happening in this deal. And then on the top there, you've got a little bit more detail. Now, once you've got this investor proposal together, you'll need to package it with supporting documentation to make it more of a compelling case. Okay. Now, the supporting documentation that is crucial when applying for a bank loan is, number one, a Lightstone report, i.e., some sort of valuation that confirms that this property is worth R1 million. Okay. Now I've got also a bunch of Lightstone videos on my YouTube channel. Go check it out if this is the first time you're hearing about it. The second report that I would really recommend that you get is TPN. Now, TPN is similar to Lightstone, but it gives you a lot more information in terms of rental information. So your rental demographics, the income levels, the education levels of the people in that area, what is the max rent you can achieve, what's the minimum rent, what's the average rent, what's the occupancy rate, what's the delinquency rate. There's a whole lot of data. TPN, great resource to include. Now you need proof of income and you need proof of expense. Now this is one of the biggest things that I see with my students is they'll see a deal in Berea, for example. Let's say it's a 2-bedroom, and the estate agent has said in the comments, he said estimated rental of between 5,000 and 8,000 rand. Now immediately that's a red flag for me. I mean, estimated rental doesn't give me any confidence. It should be rental. What is the rental amount? There's an amount that's obviously been agreed. So an estimated rental is a red flag for me. And then between 5,000 and 8,000, that's such a broad category. You know, is it 5,000? Is it 8,000? Is it 7,000? So for me, I want to see proof of income. I don't want to listen to the estate agent. I don't want to know what the estate agent's story is. I want to see either a financial statement of the owner so that I can see the actual income coming in, or I want to see some sort of documented rent roll. Like a managing agent, they'll have a rent roll, tracking all the rent that was achieved. Because guys, I can tell you now, when they're saying estimated rental of 5,000 to 8,000, it's most likely 5,000. They're just trying to use that 8,000 to sweeten the deal or to make you more excited. So proof of income is incredibly important. And then proof of expense, also important. I want to see a COJ bill or receipt. You mustn't just tell me that that's 500 Rand rates and taxes. I want to see proof that that's what's happening. That combined gives you a very, very powerful investor proposal. So we've got a couple more minutes. What I thought I would do is quickly take you through an investor proposal that I've recently created for a deal that I'm currently considering, and just talk you through essentially what the key points are here and how I'm going to approach the conversation with the bank. Okay, so I've just put here a logo, so I'm showing that I'm a business, trying to build my brand. It's a buy-to-let opportunity, investor proposal. Okay, so we scroll down. Here's the executive summary. So I've just put a little bit of content, some context. So what's the deal introduction, how it was sourced, the condition of the property, and then the high level values. Okay, so here you can see it's a block of flats, asking 2.4. I'm going to put in an offer of 1.9. It's a 20% discount. The return on investment is 11%, gross yield 19. So it's, quite solid from a financial point of view. Okay, here is my little cheesy personal introduction, some features, bedrooms, bathrooms, etc. Okay, here are the numbers. Now, this is really the crux of this deal. This is why I want this deal, because rental is 34,400. You've got all of your expenses here. Cash flow, that's 4,500. Now, who can tell me of that 4,500, if that's how much extra income I had to get per month, how much would my affordability go up? How much bank loan could I get? So my cash flow is 4,500. How much extra loan can I get? Come, let's see. He's going to give me the answer first. I'm making 4,500 per month. What's going to be my additional affordability with the bank? What's that calculation? Come on, guys, 5 more minutes. Let's do this. There we go. Kagiso, fantastic. 450,000. You take whatever it is, times 100. That's going to give you a rough estimate. So well done there. Kagiso, thanks. Some of the other costs are included here, bond costs, refurbishments, the financing. So here I've asked the bank for an 85% loan. So this is what the bank's going to loan me. This is going to be my deposit. The interest rate, I'm working my numbers out on 11% interest rate. Please, this is a golden tip. Please don't run your numbers now with a 7% interest rate. Yes, currently the current economy is a 7% interest rate, but I'm telling you it's going to bounce back. So if the only reason your deal is making financial sense because you've got a very low interest rate, you're trying to fudge the numbers. Rather use 10 or 11%, because when the interest rate does bounce back up, at least your deal will still make sense. Okay, and then here, the stress testing that I was telling you. Okay, so if my interest rate goes to 9.5, so my interest rate goes lower, it now increases my return on investment. Right, I've done that for my rental income, purchase price, all of this. So now the bank can see that I'm actually taking a lot of time into making sure this investment works, and then some future projections. Now, just before I close off, let me just show you how quickly you can build this kind of proposal using our tool, myapp.property.online. So I'm just going to quickly log in here. For those of you who want to be able to build those kind of proposal documents but don't really have the time, maybe you want to consider joining our application here. So first of all, what you've got to do is you've got to run the numbers using this tool. And once you've run the numbers, you can generate an investor proposal very quickly. So here I've run the numbers. So I'm going to quickly go into this deal. Okay, so this is the 2.4 million. So I've plugged in all the numbers into this online calculator. I've put my buying costs, etc. And this is the one that's giving me an 11.38% return. Now, if I wanted to generate an investor proposal, this is how easy it is. You just click Generate Proposal. You go to the bottom here, Generate Detailed Proposal. It opens up a new tab. Takes a couple of seconds to just put all the information and all the numbers into one page, into one structure. So let's give it a couple seconds. You can see it's downloading here at the bottom, and it's already downloaded. I open it now, and what you'll see, ladies and gentlemen, is a 7-page proposal document created for you, something that you can then just print, take to the bank, and hopefully raise some financing. And that's essentially what the app does, right? We built the app to help people analyze deals and generate investor proposals so that they can use that to help with financing. Okay, so that's the supporting documentation. We've just looked at a live deal. So yeah, it is now 2 to 7, so we've made it within time. We've gone through the basics of bank financing, how to leverage an infinite amount of money, the pros and cons, and the perfect investor proposal. So my question to you is, did you get value from that session? Did you enjoy the last 45, 50 minutes? I really did. I'm sure you can tell from my smile and my demeanor. It was just a really fun session. And what I want to do is just spend the next 30 seconds just quickly talking about this webinar that we've got coming up on Saturday, the 18th of July. The reason why I've put this webinar together is because you can't learn enough in 1 hour, So these hour webinars that I do, as much as I love them and as much as I think they are of value, it's just I don't get enough time to take you through the fundamentals and to get you really started on your journey. So what I've designed with Khapolo is to build a half-day workshop, and that half-day workshop is talking to you about the steps I took to reach financial freedom in 5 years. It will essentially be unpacking this book with all practical deals and examples. So on this webinar on the 18th of July, I'm going to share with you my proven plan for reaching financial freedom, 7 steps to determining the best areas to invest in, how to analyze deals, and I'll be using your deals as live deals to showcase. So let's say you're working on a student accommodation deal and you're not sure what to do. Bring that deal to the workshop. I'll put you live on the webinar and we'll analyze your deal together. So I'm going to analyze 5 to 10 deals on that workshop, your live deals, So I'll essentially be coaching you on this webinar as well. 5 ways to raise financing from your property portfolio, and I'm not going to look at bank financing. I'm going to look at creative ways, legals and structures, and then live deal analysis. Now, usually, ladies and gentlemen, this would be valued at $4,997, but we do have a huge discount going tonight, so it's only going to be $399. So yeah, that's like a 95% discount. We just want to get as many people there. Love sharing, love teaching. So just click that link, that green bar that says how to achieve financial freedom, to get yourself registered for that event. Action, ladies and gentlemen, that is what is going to change your life. Not the knowledge, but applying that knowledge. We also often get questions about how to get a property coach, and we do have 4 property coaches, as you can see on screen. If you do want to know more about our coaching program, please just send me an email at lawrence@housebuyers.coza with the subject coaching, and I will send you a bit more information. Fantastic. We made it to 7 p.m. Well, you guys actually made it to 7 p.m. You've been a fantastic audience. It's been really cool to have you on here. Now I'm going to take the questions. Okay, let's have a look here. So, Nyameka's first question: which bank or financial institution is friendly towards startup property investors? Okay, so that would, in my opinion, again be APSA. I'm not affiliated with APSA in any way. I just know that APSA is very keen on working with startup property investors. So that would be my honest answer. Okay, Zachariah, how much of a deposit should one put in if any? I think to answer that question, you always have to look on return on investment. Okay, sometimes getting a 90% loan seems like a good idea, but actually it reduces your return on investment. I've seen sometimes students will put in, 50% as a deposit because that's where the deal makes enough financial sense for them to work through it. So I think the simple answer would be try and get as much as you can. Try and get as much loan as you can and put as little deposit in as possible, because the deposit is obviously your money and you're going to run out of it at some point. So as much as you can, but also always look at the return on investment on the deal. Sometimes getting a bigger loan actually doesn't make the deal better. Okay, let's see. How do you find a good deal or get a lower offer accepted? So Sadiq, as far as I understand, you're joining us on Saturday. I saw your application come through. I'm not going to answer that on this workshop. I'm going to answer that next week Saturday, if that's okay, because I just want to focus on bank financing today. Okay, so here's the question: are you able to utilize this strategy without being full-time permanent employed? Yes, if you've got a steady income and you can prove a steady income, right? So if you're a commission earner, you can still get a loan. You don't have to be a full-time permanent employee, but it does help. Okay, Nikhil, why would one refinance a property instead of getting another bond? Good question. Why would somebody refinance a property instead of getting a bond? Look, when you're looking at refinancing is essentially getting another bond. So the two kind of go hand in hand. Why you might want to refinance as opposed to getting a new loan would be if you're looking for a renovation budget. Okay, so let me explain. Let's say you've got this property X, and it's run down. It's in Kempton Park. It's in a great area, but it needs 150, 200,000 rand renovations to make it really stand out. Now, if you go to the bank and say, I'd like a loan for 200,000 to build this property, the chances are they're going to say no. Or they're going to give you a commercial loan, which is really bad interest rates. That's when refinancing a property would be a clever idea. So you've got your property X in Kempton Park, but you've also got another property that you own in Midrand. And this property that you own has got 500,000 Rand worth of equity. The bank is going to be very open to giving you 500,000 Rand worth of loan based on this collateral. And you can take whatever excess you want, put it into Kempton Park, finish Kempton up, and then sell it. So the only time I would say getting a refinance approach as opposed to just getting a normal loan is if you need budget for renovations. Okay, Temba, is it a good idea to purchase a rental property with a credit card? So I would say no, because your credit card has got a very high interest rate. So run the numbers, unless it's an incredibly good deal or you've got a very low credit card interest rate, I would say it's probably not a good idea. Rather just go for the home loan. Okay, Tulani, how do I access bank finance for property when unemployed? So two options that you've got here, Tulani. Number one, try the rent-to-rent strategy. Slowly start to build an income stream through that strategy. Or number two, look at sourcing. So look at finding investment opportunities, selling it to investors, and then whatever profit you get, slowly start to build a salary out of that. Unfortunately, when you do look at bank financing, employment is pretty much critical. Okay, one more question. Let's see here. Okay, Maureen, does the bank finance in areas like Hillbrow? Good question. From my experience, and my experience is more in Berea, but Hillbrow and Berea are very similar. From my experience, yes, the banks do loan, but they're a little bit more particular on what block of flats they loan on. So if you look at an area like Berea, let's say there's, 1,000 buildings in Berea. A lot of those buildings are in good condition, and some of those buildings are high risk. Some of them have been hijacked, some of them are in very bad condition, some of them have got very dingy people living there. Now, the bank will look at a block and they will look at some key criteria. They will say, is this building insured? Okay. If the building is not insured, the bank won't lend. If there's not an insurance company that is backing that building, the bank won't lend. If the building's financials, so the body corporate of that building, if they've mismanaged funds or they're not looking after the financial health of the building, the bank won't lend. If there are a lot of defaults or a lot of delinquent tenants in that block, the bank won't lend. So, yes, the banks lend in Hillbrow, Berea, all over the place, but there are certain blocks that they will, based on their due diligence, say is too high risk and they won't lend. Now, that for me is one of the best reasons to use bank financing when you're investing in the CBD, because the banks do so much of the due diligence that you don't have to do it. You don't have to go and check if the building is insured or if the financials are good or any of that stuff, because the bank will do that before giving you a loan. And if they cancel or decline your loan for one of those reasons, well, then count yourself lucky, because you haven't bought yourself a liability. Okay. Fantastic. Guys, what a rush, man. I love tonight. It's such a good time. So what I'm going to do is I'm going to take a quick 3-minute break and just fill up my tea. And I'm going to let those of you who need to get going, you may go now. For those of you who do want to stay on the call, if you wait a couple of minutes, I will be answering the rest of the questions, and I'm happy to stay on as long as need be if there are other questions that need answering. But yeah, if you need to get going, I appreciate your time. Thanks for being here. We will send the recording out in the next few days. If you do want to stay on the line for a couple more minutes, I'm just going to take a quick break, and then I'll come back and answer the remaining, I think it's 15 questions. So I'll put some of my awesome treffer and jams on in the background. I see a couple of people registered already. Francois. Cool. Nice. Let me put on a song. What can I put on here? Oh, this is a good one. Okay. I will be back in 2 minutes. Okay. Let's have a look here. Awesome. It's an absolute pleasure, Darren. Good to have you on. Okay, guys, I'll now spend a couple more minutes just quickly answering the last few questions. I see there's still 50, 60 people on, so thanks for joining us for the after Q&A. If you do still have questions, quickly pop them on. I'm going to stay on until all questions are answered. Okay. Molefi. Do banks in South Africa allow property refinance, and if yes, for how many years? Yes. So properties, the banks in South Africa do consider refinancing. They've got different names for it. Like I know in apps it's called a further advance. So the concept's the same. For those of you who don't know what refinancing is, that's basically when you buy a property at 500,000 and a couple of years later it's worth $1 million, and you want to access that, that growth that the property's gone through, that equity. You can then refinance, which basically means to reapply for a new loan at the higher value, at the R1 million. Okay, Banele. Now that the interest rates are low, if you decide to buy, can the bank allow me a fixed interest? So he's asking, can we fix the interest rate now at 7%? It's a great question, Banele. I'm not sure. I wouldn't be surprised that they will allow you to fix the interest rate, but you're not going to get 7%. When you're looking at fixed interest rates, the banks will always have a higher rate than what the current rate is, because they need to protect themselves. So they might give you, I don't know, like let's say 8.5%, maybe 9%, and they'll say, we'll fix that. But they're not going to fix it at 7%, I don't believe. Okay, how do banks work with suretyship, and would a bank consider a Dutch income? I don't think so. So suretyship, for those of you who don't know, surety is if I don't have an income, but my dad has an income, he can sign surety that if I default on a payment, he will pay. So essentially, I'm not leveraging my income as affordability, I'm leveraging my dad's income. That's what suretyship means. I don't think a bank would consider Dutch income. Ask them. You're more than welcome to phone the bank and see. Let's see here. So Lawrence, what if you looking at cash flow will increase in the second or third year? Currently looking at a deal. Okay, so the question here is currently in year one, the deal doesn't make cash flow, but in year 1, 2, 3, 4, 5, it might make cash flow. Okay, I think my response to that is just be careful not to speculate. There's a very big difference between investing and speculating. Speculating is buying something and hoping and praying that in some future it might be worth more. That's not always the case. So, Mokate, I think what I'd like to understand from you is, why is it going to make money in year 3, 4, 5? Is it because you're expecting the rental to go up a lot, or you're expecting the expenses to decrease? What's the reason? And that will tell me whether you're speculating or actually investing. Sherwin, do all banks consider 80% of rent income? No, they're all different. So, for example, I think Standard Bank takes 80 to 90%. FNB is also about 80%. NetBank, as far as I'm aware, is the most risk averse. So they take like 60 or maybe 70%. Okay. Sadiq, yes, liability if it's your home. Okay, Mokate has got another question here. How much in percentage should we look at when we're looking at voids? Voids and maintenance, a very good question, Mokate. I think when you're looking at maintenance, I usually like between 5 to 12%. 5% if it's a new build or if it's a recently renovated property. 12% if it's old and run down. So that's sort of the range that I go in. And then for voids, it depends, man. Depends on the strategy, depends on the area. If you're looking at like Berea, a good buy to let, you're looking at 5-6%. If you're looking at a multi-let, a good multi-let, you're looking at 12 to 14%. If you're looking at student accommodation, you're looking at 18 to 20%. So that's a difficult question to answer. I would definitely have to take it on a case per case basis. Mohammed, any discount access on your app? Yeah, I think why not? We do have, I think it's 20% discount if you go for our 12-month package. But you know what? If you want to get a discount, email support@myapp.property, and I can't just give you a discount. You have to work for it. So if you do want to get a discount on our app, and I'm happy to consider it, I want you to send an email to support@myapp.online and tell us two things. One, why do you want a discount, or why do you believe you deserve a discount? And number two, when you are successful in property, what are you going to do to help other people? And then based on those two answers, I will decide, me and Khopolo will decide what discount is fair. I hope that's a fun way to get you involved. Okay, let's see here. If I want to rent, where should I start my online research? I would start with a online company called the Digs Connect, DIGS Connect. It's It's basically students who put together a business that helps other students find accommodation. I think there's a great opportunity there. Okay, logs. When you refinance a property, won't your rates valuation increase, hence higher rates, plus you're still liable for the refinance portion? So correct. When you're refinancing a property, you're essentially applying for a new home loan. So the bank's going to give you a completely new package. So they're going to reevaluate your status, your credit score, your affordability, and they might give you 90% loan, but at a different interest rate. So of course you have to take all of that into account, and you'll likely have to pay re-registration costs or bond registration costs again. Okay, Octavia, are you purchasing in your name or in a different structure, or are you using a different structure? How do you finance the deal? Okay, so I use business company, PTYs. And the best way to do it is to apply with your company, but then to give suretyship in your personal name. So I still have a salary and I still have affordability as loans. So what I'll do is my company will buy the property and they'll take the loan out of the bank, but then I will sign suretyship with my company that basically says to the bank, if my company defaults, I, Lawrence, will be liable for the bond. Okay, Sydney. So how do you do the checks if you're buying cash? Oh, yes. So I'm assuming you're talking about the Berea opportunity where the banks will check the insurance and all of that. Look, you can obviously see the financials. You can request the financials of any building. You can request the insurance status or some sort of insurance certificate. The thing is, Sydney, people aren't always willing to help or excited to help. So, for example, if you're gonna ask the body corporate for financials, they might drag their feet and not get back to you. Where the bank has a bit more clout and a bit more ability to do that. Can we access this video on YouTube? Yeah. So what we usually do is we'll have the event. The next day, tomorrow, Khopolo will do the editing and he'll send the link. And then what I usually do is next week, I'll take snippets of each section and I'll create a 10 to 15-minute video and I'll put it on my YouTube channel so you can check it out there. Banele, when you want to refinance, do I have to evaluate the property myself or the bank do? Yeah, so the bank will do the valuation. You won't have to do it yourself. They'll get a Lightstone report or get an estate agent involved. Okay, so I don't see any other questions. Have I missed one? Okay, here's Madoda. If my PTY obtains suretyship through my affordability, does then my PTY also need to present its financials or not? Yes. So for a company to get a loan from the bank, you need at least 3 years of trading history. Plus, it'll definitely need to show its financials to prove that it's got the affordability. So correct, yeah. Olani, I think. Sorry that I joined late. How is the return on investment calculated? So we actually didn't speak about that today, but there are a bunch of videos on YouTube around return on investment, so you can check it out there. Okay, so Makati, yes, the rentals might go up according to the TPN report. So might go up. I think that if your deal doesn't make financial sense today, and you and you're working on it, might go up. That's a bit risky for me, man. Okay, let's see. If I have missed your question, please just repost it. Sorry if I have. I would love to answer any and all questions. Here's a question about stokvels. So we will be talking about stokvels in an upcoming webinar, because that's something that I think a lot of people in South Africa can participate in. It's a bit of a cheaper way to use the collective to buy property. So we'll definitely do a session. I'll actually try and get one of my colleagues who's done a whole bunch of stokvel investing and built a portfolio out of that, and hopefully get them on. Okay, here's another question. Bought my properties on my name, but considering a trust to transfer. What's your advice? Now, Banele, I'm not a tax advisor. I'm not a lawyer, so I can't actually answer this, but let me just give you my opinion. A trust is a waste unless you are planning for your legacy. Okay, so if you're looking to protect yourself, buy in a company. If you want to protect your wealth, a trust is a good idea, but you first need wealth to protect. You see, a trust is going to cost at least 1,000 Rand per month to manage. Now, if you've got one property in there that's bringing in a cash flow of 1,000 Rand, essentially that property is just paying off your trust, and you're not getting any value out of it. So I would say if you've got maybe 5 to 10 properties and you've got a little bit of wealth in those properties, I would look at building a trust. To protect that. I did create a video on YouTube. It's called Structures and OTPs. And I break down the tax benefits and the structural benefits of buying in a trust versus a company. So go check that out. Okay, fantastic. That is 20 past 7. I think we did really well. Mokate, thanks, brother. Maybe we'll check you at the next event. If you do have any recommendations, guys, on a topic or something you want me to talk about next time, please, quickly put it on the chat bar or send me an email, post it on our Facebook page. Me and Khopolo love doing this. We love educating people, but you must tell us what you want to know, what you want to learn. Do you want to learn about the 13.6 Act? Do you want to know about multi-let, student accommodation? Do you want to know about financing or structures? Should I bring my accountant onto the next webinar so that he can talk to you and you can meet an accountant? I'm open to ideas. I'd love to hear from you. So I finished the questions. You're welcome to get going if need. But if you've got a suggestion, please put it in the chat bar now. I'll be on for the next 5 minutes. Happy to talk through some ideas. Let me get some of that music going again, because that music was banging. Winston, tax incentives. Okay. Structures, please. Well, what I was actually thinking, Octavia and Winston, of doing was to get my property accountant onto a call and just to give him a 45-minute slot, and he talks about structures, the tax benefits, just getting a professional, someone who does this day in and day out, to come in and share some advice. So that, I think that would speak nicely to what you guys are thinking. Anyone else? Anyone else with an idea or something that they'd love to learn more about? Ooh, seller finance. Okay, cool. Could talk about seller financing. Registering a company in the 13 Act. Yeah, okay, cool. Buying a fixer upper off market. Okay, so the flipping strategy. Yeah. Is it, sorry, I know I'm asking a lot of questions, but you guys are really engaged. So do you prefer when I bring somebody else into the conversation, like before I brought Neti on board and Maungo to come and share their story? Do you like seeing other people other than just me, or do you enjoy, the consistency of me presenting? Let me know about that. Arthur, the art of negotiating. Yeah. I definitely think we need to talk about the people. Yeah, 100%. So I would love to do a session on that. Yeah, seller financing. Awesome. We could definitely talk about that, Louise or Louis. Yeah, okay. It's absolutely freezing. Actually, have a look at that. Oh, yeah, you can't see. Never mind. The lighting is too bad. Okay, I think based on what I'm seeing here from you guys, is definitely getting my accountant on the next call. I think that's important. Registering a company, tax incentives, structures, 13 Act. Sounds good. Yeah, Makatse, thanks for your questions, brother, and for being involved, man. It was good. It was good. Thanks, Tulani. As a novice, keen to learn more, you have opened my eyes, definitely getting your book. Okay, cool. Yeah, look, my book is a great starting point because it's pretty. It's the introduction to property investing. Obviously, this webinar that I've just taken you through is quite detailed. It's quite technical, but yeah, start with my book, get a bit of just a basic understanding. Development properties. Okay, cool. I haven't done developments myself. But I can maybe get somebody here to come and talk to you about it. Cool. Sam, always a pleasure. I know you attend our events often, so thanks for always being there and being involved. Fulufello. Thank you a lot, Lawrence. I'm purchasing your book online night. Cool. Thank you. Awesome. Enjoy it. And yeah. Okay, guys, I think that's it. It's been a plum pleasing pleasure and a privilege. Hope to check you guys soon. And yeah, we'll send that recording to you as soon as we can. Okay.